Okay, so everyone should be able to see what we looked at last week. This is week 3 schedule. So really quickly, just a refresher of what we did. After our check-in, we had to talk about reinsurance, where we looked at things like catastrophe protection, liquidity of reinsurance, retention levels, and we highlighted that reinsurance should be part of the overall risk management framework for an organization. Next, we looked at ICP 17 and capital adequacy, where we looked at, for example, coverage ratios and proportionality, and we saw a little bit of risk-based supervision, which came up again then in the next session, the components of risk-based capital. We talked about the different components, which would be things like credit risk, underwriting risk, operational risk, and market risk. And then under each one of those, there were many more, subcategories. So for example, underwriting risk contains pricing risk, reserving risk, expense risk, and others. Then of course, we finished up the week with a case study. This week, our first topic this morning will be monitoring for risk-based solvency. So also will include some key performance indicators discussions. Then we'll have an hour break followed by, so that'll be Janice leading that. And then we'll come back with Craig after our break, approaches to developing regulatory and supervisory frameworks. And then after that, we'll have a little bit of discussion on your action plans. Tomorrow, we will look at the case study, the final case study on developing capabilities, and then we will spend, after our break tomorrow, the full 90 minutes, or most of the 90 minutes will be on you presenting your action plans and our closing remarks. Does anyone have any comments or questions before we move into Janice's presentation? We can go ahead and swap slides, and then if anyone has any comments, just unmute or put it in chat, please.
So good afternoon, everybody, and welcome to the session on monitoring for risk-based solvency. So I'm Janice Angove. I did see many of you in our first meeting a few weeks ago, and I'm assisting the Access to Insurance Initiative with looking at key performance indicators for prudential matters for insurance supervisors. So there is a paper that will be published on looking at KPIs for prudential matters later this year. So have a look out for that paper because it will explain a lot more detail around these KPIs. So let's, we can go to the, let me take control. So just a quick overview of the things that we'll talk about today. So we're not going to cover everything that we looked at in the videos earlier this week. So we'll focus mostly on how to look at weaknesses and risks around the financial position or financial soundness of the insurer, risk management, and also the claims, expense, and investment experience. And thank you to everybody who's been contributing to the forums. So it's been very good insights to understand the key risks and the challenges that you're facing in your markets. And also the main purpose of the forums on warning indicators and the last forum on challenges around collecting data and analyzing data is to really also give you an opportunity to share with other people in this training on solutions that you've tried that have worked. So thank you very much to everybody who's been sharing in the forum around what actions can be taken when you identify certain risks that the insurer is facing, and also any actions that you've taken to try and overcome some of the challenges around gathering data and analyzing data. So just a broad overview of everything that was covered in the videos. There are 7 main areas that we can investigate when we're looking at the solvency and the risk management of insurers. And you should be able to get information to assess these issues in your regulatory returns, in the annual report that the insurers produce, in your valuator's report, and in the ORSA report or the financial condition report. So we would look at the quality of assets, and here we would look at whether the insurer is invested in risky assets or assets that are likely to have volatile values. We would also look at the credit risk relating to assets and whether there's a concentration in terms of an individual counterparty, as well as any investments in related parties. Then in terms of the sufficiency of provisions, we can see whether our claims, actual claims that are paid, are what level they are at relative to the original reserves that were held for those claims for non-life business. And then for life business, it might be a little bit more challenging to investigate the sufficiency of provisions because you are going to be relying on the valuator's reports. But here, to have confidence in the level of the insurance liabilities for life business, we really need to understand whether we can have confidence in the data that was used in those calculations, whether the assumptions are reasonable relative to other insurers in the market, whether they are using the actuaries used an internationally accepted valuation method, and then how sensitive are the results to any changes in assumptions, and whether the insurer has been making losses relating to mortality over time or to expenses over time. So there's a lot of information in the valuator's report that can help you to assess the technical provisions or the insurer's liabilities, and over time you will develop more confidence in this area. Then we would also consider whether the reinsurance is suitable for the business in terms of reinsuring individual risks, as well as catastrophes and the credit risk for reinsurers. And then overall, a very important indicator will be the sufficiency of the available capital. And here the insurer should be assessing their available capital both on the basis prescribed by the regulator, and also we talked a bit about how the insurer should be looking at their capital needs based on their business plans or the individual risks that they're facing, and how they should be looking at those issues in their ORSA reports. So we need to look at both of those aspects. Then in terms of business volumes, if the business volumes are too low, then the insurer is not likely to be viable and they might not generate sufficient capital to remain in business. But if business volumes are growing very quickly, this could also affect the capital position of the insurer because it takes quite a lot of money to sell a new policy because of high initial expenses. So we also need to be very careful that the insurers are not growing too quickly based on the capital that they have available. And then for our claims experience and our expense experience, this could impact, losses in these areas could impact on the financial position of the insurer and result in a decrease in the available capital over time. And then finally, we need to bring all of these areas together and look at what capital the insurer really needs relative to the risks that they're facing. And we also need to consider how well is the insurer managing their risks. So that's a very quick overview of everything that was discussed in the videos. What we're going to do now for the rest of the presentation is to have a look at some examples of some indicators that can be used to assess the risk of the insurer, and then we're going to have a number of polls where we will rate the risk of the insurer based on the indicators that we have. So our first indicator is to look at the quality of assets. So here we have indicators for 2 years of data, so year 0 and year 1. We can see the proportion of government bonds that this insurer holds. We can see the proportion of unmarketable assets that this insurer holds. So for our unmarketable assets, this would include assets like property investments, unlisted equities, and debtors, so maybe receivables from reinsurers. And then we have the proportion that's invested as cash deposits in a single bank in that country. And then separately, we have some indication of the investments in related parties. So this, the investments in related parties might be classified as unmarketable assets in the table above. So let's have a quick poll to see how you would rate this insurer based on the quality of assets, given the proportions that are invested in government bonds, unmarketable assets, and bank deposits, as well as the investments in related parties. So you can rate the insurer as high risk, moderate risk, or low risk. And then we'll talk about some of the reasons for that rating. So maybe for the people who've already voted, you can, over the chat or even over the mic, let us know why you decided that this insurer should be voted low risk or high risk or moderate risk.
Okay, I choose high risk.
Okay.
This is Abdul.
Thanks, Abdul. So why do you think that the insurer should be high risk?
Because if you look at between the 2 years or the 1 year, you see that the quality of assets has reduced drastically. Because, for instance, government bonds are the safest investment instrument, and the firm has moved their assets from 45 to 20%. That is over 50% decrease. And they've also increased their unmarketable assets as well as increased their deposits. Okay, so the fact that they've increased their deposit in AA Bank is good, but the investment in related party transactions, when there is default, credit risk, it can hit the company so badly. So investing so much in related parties exposes contagion risks. That's why those are the reasons why I feel the company is of high risk in terms of quality of assets.
Great, thanks. Thanks, Abdul. Does somebody else have another additional comments to justify their rating? I'm happy if you also answer in the chat. So do you think that the risk of the insurer is stable, or do you think it's increasing over time? Okay, so we can say that it's high risk and it's increasing. So that's also very concerning for us. Do you think it's acceptable for the insurer to have all of its deposits in one bank? Thanks, Abdul and Clinton.
Darren, what do you think?
It won't be appropriate to keep all your assets in one bank because the exposure would have been very high if the bank should go bust or if anything should happen to the bank, as in also once again credit risk there will be very high if the bank should become insolvent. Indirectly the insurer will also become insolvent. That's one reason.
So thanks, Darren. So even though it's good that the insurer has got some liquid assets in a particular bank, it's not necessarily the best idea to have all of those cash deposits. Oh, sorry, Abdul. It's not good to have all of the assets in the same bank. So definitely we should think about rating this insurer as high risk as increasing, and we would be concerned about the high levels of unmarketable assets and also the high level of investments in related parties, because investments in related parties might be overvalued. And also there is the issue of maybe not being able to sell those assets when you need to. So let's maybe have, I know that quality of assets was highlighted as a problem in quite a number of countries. Maybe we can have 2 or 3 people let us know what solutions or what actions they might require the insurer to take to address these problems. Okay, Clinton.
Okay, so I think one thing the insurer can do is, the supervisor can do is tell the particular life insurer to diversify their portfolio, especially considering that they've placed a quarter of their investments with just one bank. And of the total investment that they have 30% in related party. So in Ghana, the ideal thing is usually when we want to grant you a license to be an insurance entity, you have to show 60% of your investment in cash and 40% could be in assets. But with cash, the minimum should be 60%. So that, 60% of your total assets should be in cash, so that you don't really invest a large chunk of your money in a marketable asset or marketable investment instrument. So that could be one way to go about this.
So thanks very much, Clinton. So I think that's a very good point. It's good to have regulations to help support your rules in terms of limitations on investments in risky or unmarketable assets. And it's very good to also make sure that the insurers are complying at the licensing stage instead of trying to get them to correct the problems later on. So that's a very good point. Does anybody else have something else that they would like to share in terms of how you could approach addressing these challenges? So Tulani and then Nathaniel,
Okay.
do you want me to repeat the question?
Oh, no, I've got it. I think
Okay, great.
I think another way to do it is to sort of discourage concentration by having like concentration limits on, for example, on like a company that you can invest in. So that would encourage insurers to diversify. And another thing is to perhaps introduce the capital charges on some of the investment instruments so that it increases the capital requirement for the insurers that are not complying with best investment practices.
Great. Thanks, Tulani. So I think that's also a very important point. So there are 2 ways that you can deal with issues around market risk and concentration or credit risk. So the one way is to have a list of maximum investments that you can have in particular types of assets or in single investment counterparties. And many regulations do have maximum investments in types of assets, but not necessarily by type of counterparty. And then also you can, another method is to allow the insurer to invest in whatever they like, but then if they do invest in risky assets, then they need to hold additional capital. So both of those methods are used in practice. Nathaniel, do you have something to add?
No, I'm okay.
Are you okay? Great.
Mm-hmm.
So thanks, everybody. So I think that these are all important things that you can think about when you go back home. Well, you're already home. When you go back to work every day and you don't have training anymore. Okay, so let's have a look at the technical provisions. So here we have 3 ratios and then 1 assessment from the valuation report. So here we can see that our sufficiency of technical provisions is less than 100%. So that means the reserve that we were holding, or the provision that we were holding, has been lower than the actual payments for those that class of business over time. And we also have some weaknesses in our assumptions that we're using for the calculation of our technical provisions. So here we have the estimate is 65%, whereas the actual loss ratio has been 85% for a number of years. So our maximum event retention tells us the amount that the insurer is retaining after its reinsurance program. So if there's a single large risk, the insurer will have to pay the amounts of the maximum event retention in claims because that part is not reinsured. So if that is quite a high proportion of the capital, if a very severe risk event happens, then the capital is going to be depleted. And then also we know that the exposure to the reinsurer, a reinsurer that has quite a low credit rating, just a BB rating, is 50% in year one. So let's rate this insurer based, and this is a non-life insurer. So let's rate this insurer based on whether it's high risk, medium risk, or moderate risk, or low risk, based on that information that we've received. And thanks, Mark, for sharing your investment limits. I think that'll be helpful for everybody to see. Okay, Darren.
Yes, I can see from the answers coming in, there seems to be a clear consensus that it is high risk. And I think that stands out particularly from the fact that it's clear that the technical provisions seem to be inadequate over both years, but the inadequacy, I can say, I think, increases over this 1 year period. And I think, the fact that the assumptions in setting these provisions are not updated based on current data and current experience shows a weakness and shows why this should be high risk. And if you go further to look at the maximum event retention, the fact that it goes up, even though exposure to reinsurers have increased, it indicates that possibly more business might have been written over this time. But then again, things have decreased. So there's a misalignment between the planning within this non-life insurer. So it is definitely high risk.
Thanks, Darren. So I think that makes a lot of sense and a good justification. So these are the types of things that you would talk to the insurer about when you're wanting to get them to change some of their policies, or to change how they're planning their reinsurance, or to change how they valuing their liabilities. Yes, so definitely we can also see, thanks Clinton, we can definitely see that the risk also is increasing over time, and there is quite a big change in the reinsurance relative to the risks that have been that the insurer has been taking on. So that Darren has highlighted. So the other issue, so nobody's talked about the credit risk part of the reinsurance assessment. So I don't know if anybody wants to comment on that. Chesney, you can have a chance next time.
So I thought Chesney was going to respond to the question, that's why. So yeah, the fact that the maximum exposure to risks as compared to the insurance available capital is 45%. And then with that, you could say, okay, I have better reinsurance arrangements in place and I could phone the reinsurer for within any such circumstances. But realize that I'm also 50% exposed to just this particular reinsurer whose credit rating is a BB, and I think that's a matter of concern.
Okay, so thanks very much, Clinton, and Usama's also highlighted this issue. So it's can also be a challenge if the insurer has got a very high exposure to a single reinsurer, and then we are also quite concerned if that single reinsurer doesn't have a good credit rating. So these are the types of things that we would look at in terms of the technical provisions and the reinsurance. Let's have a look now at our capital requirements and risk management. So here you're going to get information both from your regulatory returns, but also from the ORSA reports and the FCR reports. So we can see how important it is to get some qualitative information from the insurer to understand how they are looking at risk and how they are managing their capital. So here we have an insurer with the solvency cover. So that tells us our available capital divided by our required capital. So if it's higher than 100%, then they have a higher level of available capital compared to their required capital. We can see that if we do a stress test and see what the impact of a fall in the value of equities is, that our available capital is going to fall by 30% in year one. When we look at the information in our ORSA report, we can see that the insurer is not reinsuring its group business, and there's been a high number of claims, and the insurers identified this as a risk. And then also when we look at our ORSA reports and our FCR reports, we can see that there's no stress scenario for mortality risks. So they've only performed a stress scenario for investment risks. So let's do our poll again. So how would we rate this insurer looking at their solvency levels and also their risk management from their ORSA report?
Thank you. Sorry, I had to remove my mask. I voted moderate, so I'm going to respond on the moderate side. My opinion is these companies, the level of risk is still moderate, but it is increasing. And the major drivers of this is actually because of this lack of reinsurance for group risk, which is actually also experiencing high level of claims. I think if they had reinsurance, it would moderate the risk and it would stabilize the capital, and that's why the solvency cover has dropped a bit. If they could only arrange for insurance, which could share this risk, this reinsurance claim, these group claims coming up, then they would stabilize their capital cover. But also the fact that they are not doing stress tests on mortality risk, it is not giving them a picture of how they could have seen this coming if they had done stress tests before, and probably they could have made an appropriate decision of making arrangement for insurance and the like to ensure that their capital is stable and is not being eroded by this increase, this level of claims. So I think I still remain moderate, but I think it is on an increasing trend. I submit.
Great. So that's a very good insight. So the insurer is still solvent. So what you would check that solvency cover number against is your own regulatory requirements. So some countries require the insurer to have a margin above 100%. So if that 120% is still compliant with the regulatory requirements, then the insurer might be okay and be on the moderate side. Some of these challenges, like the stress scenario that's missing from the ORSA report, can probably be solved quite easily. But we definitely want to keep put the insurer on the increasing risk capital. And both Clinton and Mark have highlighted that if there isn't an intervention and something deteriorates in the following year, so in year 2, the insurer might be below the solvency, the 100% solvency cover level. So definitely we wouldn't want to leave the insurer as it is. We do want them to consider some of the risks that they're facing and to address some of those risks in terms of maybe their exposure to equities and also the lack of reinsurance for their group risk business. Does anybody else want to add a comment in terms of the risk management?
So I think as Bonnie said, I also voted moderate though. It's not far-fetched. These are matters that the supervisor could easily intervene, and I think the measures that the insurer needs to put in place are not that rigorous. Because if I have just a 5% compare from year 0 to year 1, then I can easily show up the fall in equities to come back to the previous levels. And with the OSA and FCR reports, you could easily instruct them that going forward, you expect that they perform stress scenario for mortality risks. Howbeit, we should also consider the fact that there are a whole lot of background information that we don't have. Because it could also mean that the life insurance is relatively new and they don't have enough experience to perform mortality risk assessment on the portfolio, on their liability portfolio. So these are also matters that we have to consider.
Great. Thanks, Clinton. And Bonnie, did you want to respond to that?
No, not necessarily. I know I have my Ugandan friends on the call. I just wanted to make it clear that if this was a Ugandan case, because our requirement for capital, the cover for capital is actually 200%. This insurer would already be under statutory I don't know how to call it. Would already be under regulatory management by now. But given this particular case, yes, the risk is still there. Thank you.
Great. So Jennifer's also said that she might have rated this insurer as moderate because it can be the issues can be solved quite quickly. But I think the key issues to take out of this debate, because there are this is something that can be rated either moderate or high, depending on what's happening in terms of other areas of the insurer. So yes, we need to look at the solvency cover to make sure that it meets the regulatory requirements, and your regime might be stricter than 120%. We need to see whether the stress scenario is, how likely the stress scenario is to happen. If it's something that happens quite regularly, then this might be of a concern. And then we do bear in mind that some of these other problems might be addressed quite easily. So depending on the context, we may consider moderate if this is not a serious problem. If it is a more serious problem, we might consider rating the insurer as high. Great, so thanks very much. So there's one more rating. Sorry that we're a little bit over time. So yes, so most of for most of the countries, 120% is not going to be enough. Thanks very much. So here we have the claims ratio, the expense ratio, the investment income that's earned, and the profitability ratio for a non-life insurer. So let's vote. Let's have a rating on the poll in terms of whether we think this insurer is high risk, low risk, or moderate risk. Maybe we don't have time. maybe let's just have a couple of comments on what weaknesses do you see in this insurer to justify your answer. And
okay, this Abdul. First of all, I want to comment
what concerns would you have?
Okay, this Abdul. First of all, I would like to comment on the claims and the expense ratio. If you add this, you are going to get over 100%, and that will mean a combined ratio of over 100%. And clearly, you can see that company's profitability is threatened. So it's not far-fetched, depending on the jurisdiction in which you are operating. In other advanced jurisdiction where pricing is key and there's capacity to actually price properly, this could be a cause for concern. But in other jurisdictions, some supervisors may take it not to be so far-fetched, especially considering the fact that the expense ratio remains the same. It's just the claims ratio that has increased. And once it's a general insurer, probably there could have been some kind of risk, unusual risk that occurred within that year that would have brought the combined ratio over 100%. So it clearly is overboard, but it's not too much of a concern. So I'll rate this as moderate.
Thanks, Abdul. So I think that's a very important insight. So there has been a worsening of experience, but we don't really know what the cause is and whether that's likely to continue in the future. And also, we didn't explain whether this is for just one class of business or whether it's for the whole insurer. So maybe we don't want the whole insurer to have a combined ratio of over 100%, but maybe it would be acceptable for a particular class of business as long as some of the other classes of business are profitable. Maybe we can just have another 2 people comment before we close. Okay, so again, we would have a look at whether we would expect this to be happening in our country if these ratios are reasonable relative to the other insurers in the markets. We would also consider the cause of that increase in the claims ratio. So whether we would rate it as moderate or low depends on the market, but we should definitely consider that maybe the risk is increasing over time and then ask for a justification for that change in the claims ratio for the insurer. And then last point is I really want to encourage you to continue to post your comments in the forum in terms of the challenges that you faced in terms of gathering data and analyzing data, and then some of the solutions that you found to those challenges so that we can share with each other in terms of looking at ways that we can overcome some of the challenges in terms of the accuracy of the data and the availability of the data and the time it takes to analyze everything. So thanks very much for all of your participation and for all of your suggestions. And I think we will hand over then to Dunya again to close, or Jeff to close the session. Does anybody have a last question maybe? Sorry, Jeff.
My last question would be, I don't know if Elias is still on. He was on earlier, but it'd be interesting to hear his answer to some of these questions. I don't know if he's still on or not.
Yes, I'm on. I'm on.
You have very good insight. So what, let's say, so in terms of data collection, what do you have any comments to add?
Yeah. So I think there are a couple of things that I would want to share. Particularly when it comes to data, one of the key things that we would basically recommend from a regular perspective is to have a framework that will continually improve the data collection, because one of the things that you wouldn't want to do as a supervisor is to kind of have what we can call an onerous data reporting structure. So over time, you could look at ways in which you could improve the data quality and also the quantity of data, and that cannot be achieved at once. The thing is that you must have, I would say, a structure to make that happen. Also, you might also need to think about what are the key ratios. Now, there are some ratios that will give you, like I would say, similar information. So you need to kind of sieve through which are the key ratios that we could look at a glance. Then maybe further, if you want to, in a way, get more insights in a particular company, you can dig deeper into maybe reviewing other ratios. So initially, you have what we call the base ratios or the primary ratios. Then further, you can look at what other secondary ratios that would give you more information or more insights about a company. And another thing that is important is that yeah, there are various barriers for implementing more like data collection and analysis processes. So the key thing is to also come up with what we call some validation checks, because companies will be submitting information, and some information or data might not be correct, and also might have some form of what we call creative accounting for the purposes of trying to get around the regulations or something like that. So you need to think about what we call an early warning system that is connected to more of like a validation check mechanism, that once the information is submitted, you could quickly be in a position to think about basically to flag out some of the information that might be inconsistent or might not be correct. Not all companies will submit correct information. Some might submit that incorrect information without their knowledge. But importantly, as a supervisor, we need to have some ways in which we can flag some of this information and basically engage them into some discussions. So ideally, when it comes to overcoming barriers, I think the regulator must have a structure in which they can continually look at ways in which they can improve their data sets. They can set mechanisms of identifying incorrect information and ways in which they can continually discuss to get clarity in some of the information that has been flagged. You can have 3 different layers of ratios, from primary to secondary to also more so you can call that tertiary, so that as you dig deeper into understanding a company, you can go further to other ratios that might give you more information regarding an institution. I think that is the submission. Thanks.
Yeah, I think from Janice's presentation that it's obvious that data and being able to calculate the ratios that she highlighted are very useful, but it's also very useful to be able to do it for more than 1 year and see where the trend is going, if it's worsening or getting better or staying level. So we have another comment in the chat, Janice.
Thanks, Jennifer. So this is a very good question, and as we saw in the chat with the different minimum solvency covers or solvency ratios that different countries have, that there is some variation in the experience. So in terms of the indicator of the ratio, so we definitely would want the insurer to be above 100%. So we would consider that the insurer is likely not to be able to meet its obligations if its ratio is below 100%. But then we need to consider that we might want to have a margin above that in case something goes wrong. We don't necessarily want the insurer to be sitting at maybe 101%, and then next year the investment markets fall and then they are below the 100% level. So it's always good to have a slight cushion above that 100% margin so that they will still be have enough available capital if something goes wrong in the following year. And then in terms of how high that margin should be, so I mean, Ghana, I think, was it Ghana or Uganda said, Uganda said 200%, Jordan said 150%, I think Ghana was also 150%. How big that margin is will also depend on how onerous your capital requirements are. So if you, Craig's going to talk this afternoon a little bit more, and I think Elias spoke last week about different ways of calculating capital. So if we have a very simple capital regime that doesn't necessarily differentiate between risk or doesn't take all the risks that the insurer might be facing into account, then we might want to have a higher margin. So maybe we want to be at 150% or at 175%. But if our capital our required capital calculation takes most of the risks into account and is quite onerous, so it takes very extreme events into account, so maybe our capital calculation might only consider increases in mortality that could happen every 10 years. So quite regularly, maybe there could be a 10%, or no, let's not, a 3% increase in mortality.
Mm-hmm.
But now with COVID in South Africa, we've seen a 30% increase in our number of deaths. So if our capital requirement is only for a 3% increase in mortality, then we might want to have a higher margin and say maybe we want to have 150 or 175%. But if our calculation of our capital requires the insurer to hold enough capital for a 30% increase in mortality, then maybe we might be happy with 115% margin or 120% margin. Does that make sense, Jennifer? There are quite a lot of points to think about.
Maybe also I could add, importantly, the way you said that it will depend with the risk tolerance of a supervisor on the way they are calibrating their capital. Also important, I think we discussed last week, the benchmarks are important, but when it comes to ratios such as solvency ratio or capital adequacy ratio, you need to think about the supervisory ladder of attention just to ensure that you don't expose the policyholders by basically these companies failing. So as you have or develop those benchmarks, it's also important to think through what is a supervisory ladder of attention and what actions will be taken at each and every stage of where the company is as per the capital adequacy ratio or the solvency ratio. Now, there are other ratios that also you might need to have, for instance, some benchmarks, and there are two ways you can think about it. So, for instance, I'll give an example. In Kenya, there are benchmarks that have been set, and these benchmarks might be internationally acceptable benchmarks. So, for instance, you'll get that when it comes to a ratio such as a claim ratio or a loss ratio, you'd hear institution talking, regulators saying that this should be between 50 to like 70%. What happens if that ratio goes beyond that particular range? What would you go back and look at really what might have made this company go beyond that particular range? Or so some range or benchmarks are basically set as per the international benchmark. But also in Kenya, what you could see, there's also what we call the industry benchmark. So for instance, there's analysis that have been done on the ratios for the last couple of years, and you definitely be able to get where the companies would ideally fall when it comes to the ratio. So within that, you can check a company against an international benchmark and also companies against their peers, because maybe a company is performing much worse than its peers, and that from a regulatory perspective you might need to think about why is this particular company they are within it's a small company and all other small companies having this level in terms of ratios, and this company is basically off that particular peer group. So what's really happening? So there are various ways that you can also look at benchmarks, and ideally it will be important to look at the industry-based benchmarks and also the international-based benchmarks, and kind of look at how different entities are performing and pull out some insights on what you need to do as a regulator, maybe if a company is falling outside a particular range. I wouldn't want to go into the methodology that was applied to come up with the industry benchmarks, but yeah, so if somebody would be interested, we can have that discussion later to save time. Thanks.
Thanks very much, Elias. Yeah, so that really gives a very rounded explanation. Jennifer, does that all make sense to you? Thanks. Maybe we've got time for one more question.
Well, while we're doing, yeah, we can go ahead and swap the slides out and keep sending your questions in. So if you think back to the last 3 weeks, the topics we're hearing this week from Janice and Craig and in the case study, it's all been accumulating. The knowledge has been accumulating for 3 weeks, and these topics now are kind of high level, and they pull everything together we've been discussing. So what we have here is a quiz that covers all the webinars you've seen over the last 3 weeks. It's just a chance to kind of refresh your memory of everything you've looked at. And are there any other questions related to Janice or Elias? So you can keep sending them in. It's a really good discussion this morning. Thank you, Janice.
And thank you to everybody who participated and shared. I think that it really helps when we also talk about what we do practically every day as a supervisor, and we can learn from each other. So thanks very much.
I guess you could call this a pop quiz because in the agenda we didn't say anything about it, but this is a surprise last final quiz. We have I think 9 questions. We want to go ahead and pull up the poll. The first question is key risks to capture within risk-based capital include underwriting, market, credit, and operational risk. Which insurer would you expect to have a higher proportion of its RBC to be made up by market risk, a life insurer or a general insurer? I guess I shouldn't vote because I have the answers. Sorry, I won't vote on anymore. So yeah, by far everyone is picking the life insurer, and the reason is that we talk about market risk. That's a large part of that is investment, and a life insurer is more likely to have long-term reserves, and investments would have a bigger impact on its income, its total profits. So I'm going to keep moving quickly given we've got 10 minutes, but I'm always watching chat if someone wants to comment on anything. The second question is a true-false question. The coverage ratio should be greater than 1. It is defined as capital requirements divided by capital resources. Right, so everyone's voting false. One person voted true. What is the reason that it's false?
So it's apparently the resource over the capital requirement. It's the other way around. It's not defined as.
Right, the calculation's upside down. The resources need to be greater than the requirements. And as we go farther through this quiz, we're going back in time, going back towards week 1. These were all questions from just last week. Question 3, the supervisory ladder, every time the poll pops up, I have to keep, there we go, now I can see again. The supervisory ladder describes intervention trigger points as an insurer solvency position worsens from, and you have 3 options, from the PCR towards the MCR. Another option is tier 1 resources to tier 2 resources. And the third is central estimate to the MOCHI. Okay, everyone's getting the right answer. So the PCR is the prescribed capital requirement and the MCR is the minimum. So as you move from the prescribed to the minimum, your solvency position is worsening. Question 4, the ceding insurer's blank is the amount of risk retained. Options are credit risk, concentration risk, retention, and risk appetite. Okay, everyone is correctly voting for retention. That's correct. Now we're entering, I think, week 2 topics, which is not an example of qualitative information. This is from the ICP 14 solvency valuation. Information to judge the professionalism of the actuary. The actuary should demonstrate knowledge of the insurer's underwriting process. The actuary should demonstrate sound judgment regarding data quality and valuation methods. And technical provisions exceeds the current estimate by a margin. So most people are voting for the final option, and that's correct. So the first 3 are all qualitative. You're trying to assess the professionalism of the actuary, the reasonableness of what they've done. Some people have voted for, yeah, some of them do sound almost non-qualitative. They have a quantitative element. Question 6 is true false. Actuaries are required to audit data before using it in an actuarial report. Well, you do want actuaries to show that they've assessed the reasonableness of the data and tell you where it came from and if they've relied on others. And you shouldn't just pass the bill and say, I didn't check the data. You do not require actuaries typically to do a full-blown audit on the data. That would be onerous. So you want them to do some validation, maybe spot checking, tell you how what they compared, the data against at a high level to make sure that they'd captured all the, for example, all the data that went into the reserves or all the claims, should match financial statements and explain why they don't match, or tell you why data was excluded or what adjustments they made for bad data. But a full-blown audit would be more than what's typically required. But if you get a report that tells you nothing about the data, that would be a concern. Question 7 is another true false. Insurers are required to have effective control functions with the necessary authority, independence, and resources. Depending on the size, nature, and complexity of an insurer, some of the control functions can be combined. And this is from ICP 8, Risk Management and Internal Controls. Okay, most people are picking true, and that's correct. For example, some functions that can be combined would be potentially risk management and actuarial may sometimes be combined or have some overlap. There was one function, I guess this is a trick question also, because there was one function that cannot be combined. You'll remember that is internal audit. You want that to be independent from the other internal controls. So I'm guessing that the 2 people who voted false were thinking of that internal audit necessary, and it needs to be separated. 2 more questions. Number 8, We have 2 minutes and 2 questions. We're doing great. ORSA can be simplified into a 4-step process. The steps are identify key risks, risk and capital adequacy assessment, communicate the results, and blank. So you need to answer this one in chat. Oh, no one likes the fill in the blank. We've heard monitoring, feedback, review of the ORSA process. They're all very similar. Zahira got the wording perfect. The final step would be review the process. But I could see how monitoring and feedback are potentially saying the same thing without the exact same words. So yeah, the ORSA process is, if you want to boil it down to 4 steps, it's identify the key risks, do a risk and capital adequacy assessment, communicate results, and then review your process. Last question. This is from the very first session we heard, insurer distress. Issues leading to insurer distress include risk profile, technical issues, contextual issues, and blank. You see governance, internal. Good memory, everybody. It is governance. So the main causes of insurer distress we heard about were risk profile, technical issues such as mispricing, contextual issues, and governance. That is the end of the quiz. Everyone gets an A+. We're at break time. Is there any other comments from participants or trainers before we head into break? Everybody wants a lunch break? I will quit talking. Janina, I see you're unmuted. Anything else?
No, I just wanted to say thanks to Janice first of all for the great session and everyone's participation, and well done everyone on the quiz. I think that was a good recap. And unless anyone else has something to add, looking at Janice, no. I think we can break for lunch and see you all in an hour.